Walmart's secret 40-year weapon is the $48 billion float between cash collected from customers and cash owed to suppliers. That interest-free loan refinanced itself every quarter for 4 decades. In the last 18 months, it stopped growing. Cash from operations growth dropped from 12% annual to 3%. 3 forces did it. Wall Street has not noticed. For 40 years, Walmart's structural moat was negative working capital. Pay suppliers on net 60 to net 90. Collect cash from customers in 48 hours. The gap built a permanent $48 billion pool in Walmart's bank accounts. Sam Walton's 1992 memoir explicitly framed supplier pressure, paying suppliers later and squeezing harder than anyone else, as the deliberate operating core of the company. The supplier leverage was the moat. The float was just the consequence. 3 forces are eroding the supplier leverage simultaneously. First, supplier consolidation. In 1980, Walmart faced roughly 250,000 fragmented food and CPG suppliers. None of them had the category share to refuse onerous payment terms. Today, Walmart's top 10 suppliers, Procter & Gamble, PepsiCo, Coca-Cola, Nestlé, Unilever, Mondelez, Kraft Heinz, Johnson & Johnson, Tyson, General Mills, collectively control 25 to 28% of Walmart's COGS. They have category share leverage Walmart cannot one-sidedly squeeze anymore. In 2023, P&G publicly renegotiated Walmart's payment terms to net 45 against the previous net 90 demand. Within 18 months, 6 of the top 10 suppliers had secured equivalent renegotiations. Second, e-commerce mix shift. Walmart.com first-party still has favorable supplier terms, but Walmart marketplace third-party sellers settle on 14-day cycles by mandate, not negotiation. 3P was 3% of Walmart e-commerce GMV in 2020, projected 12% by 2027. As 3P grows, the float pool shrinks proportionally. Those dollars never enter the supplier float at all. Third, Amazon Prime same-day and next-day delivery is eating Walmart's foot traffic moat. Weekly Walmart visitor counts flattened in 2023 to 2024 for the first time in a decade. Foot traffic is the entire reason Walmart could squeeze suppliers harder than anyone else. If Walmart is not the largest funnel anymore, suppliers negotiate from a different starting position. Walk through the cash flow consequence. Q4 FY 2025 10K, cash from operations of $36.4 billion, growing only 3.1% year-over-year, against the 5-year average of 11.6%. Net income up 8%, but cash flow lagging income for the first time in over a decade. That lag is working capital deteriorating in real time. Accounts payable days dropped from 47 at FY 2023 to 42 at FY 2025. Receivables days inched up from 4.5 to 5.8. Net working capital float compressed by an estimated $3 to $4 billion. At a 5% treasury yield, that is $150 to $200 million of incidental interest income gone, small compared to the bigger loss, which is the unleveraged working capital that Walmart now has to backfill with external borrowing. Single cleanest data point in the FY 2025 10K. Walmart's commercial paper outstanding hit $2.5 billion in Q4 FY 2025, first non-zero quarter since 2009. Walmart literally did not need short-term external borrowing for 16 consecutive years because the supplier float covered all working capital needs. 16 years, 0 quarters, now $2.5 billion outstanding. The reappearance of commercial paper on the balance sheet is the cleanest possible single signal that the supplier leverage engine is no longer covering the working capital need. P&G's 2023 renegotiation was the trigger. 6 top 10 suppliers followed within 18 months. The supplier base is, for the first time in Walmart's history, exercising collective leverage. Wall Street analysts are still modeling steady CFO. The 10K disclosure says otherwise. Here is what makes this slow motion. The float is a balance sheet asset that compounded over 40 years. It does not vanish in a single quarter. Walmart still has more than $40 billion of working capital advantage left, but the rate of change has flipped sign. For 40 years, working capital grew at single-digit percentages annually, compounding into a fortress. For the last 18 months, it has been shrinking single-digit percentages. The unwind is symmetric. It took 40 years to build. It will take 10 to 15 years to dissolve. The dissolution has begun. Wall Street prices Walmart on EPS multiples. The story is on the cash flow statement, line item changes in operating working capital. That number is now negative. The fortress is leaking. Lesson: when a company's competitive advantage is hidden in the structure of its working capital, the public market will misread the early signs of erosion as mature business. Walmart is the textbook case in progress. The float was never the moat. Supplier leverage was. The leverage is eroding because of three independent forces compounding at the same time. The cash flow statement is telling the story 2 to 3 years before the income statement will. Investors who only read EPS will be 24 months late recognizing what is happening. The companies that beat low-margin retail were never just running stores. They were running balance sheet operations. And balance sheet advantages, like all advantages, are temporary.